What if this time really is different? What if there's no recession? What if there's never a bear market and AI boosts efficiency so much that this bull market keeps on going for another 10 plus years? Whenever markets are strong, most investors tend to split into two camps and not equally. One group becomes convinced this time really is different, that innovation, technology, productivity have fundamentally changed the rules of investing. I want you to keep in mind, innovation, technology, and productivity will have fundamentally changed. The question is, have they fundamentally changed the rules of investing? They believe cycles are a thing of the past, and that staying fully invested at any price is the only move. Of course, they don't say it that way, but that's what the actions show. Anything else would just be stupid. The other group, again, not the same size, does the opposite. They wait, they expect a crash, they sit in cash, they're convinced that disaster is right around the corner and that patience alone is the only thing that'll save them. Now here's the problem. Both approaches miss the point. You don't build wealth by predicting the future perfectly, and you don't protect yourself by hiding from the market either. Real investing lives in the uncomfortable middle, where you accept uncertainty, but still act with discipline. That's why this conversation matters so much. Because as we move forward in 2026, whether the bull case plays out completely or reality turns out to be messier than people expect, the same question always decides the final outcome. What price are you paying for the shares that you're purchasing? Now, most investors focus only on what will happen next. Recession, no recession, AI dominance, economic downturn, economic slowdown, whatever the myriad of issues are. And during periods of great innovation, they skip their much needed due diligence because they have a fear of missing out. FOMO is such a powerful term that has been used a lot in the last few years. And we're not going to fall for that trap. So let's look at what history shows us about market cycles and go forward from there. Hopefully, I can help you better understand how to do well, no matter where stocks are heading. And on a personal note, I want to add, guys, sometimes I wonder, is it just different this time? Are we just going to be headed into a world where higher valuations are expected? So I don't want you to think that even with my confidence in valuations, I don't still question what would have to happen? That's the question I always ask. What would have to happen for it to be different this time? Now, one really important piece of information investors misunderstand is a statement: the market has returned 9 to 10% a year since its inception. People get the idea that because it returned 9 to 10% on average, that they should expect that year in and year out. Back in 1999, I met a neighbor of mine. This is back when I thought stocks were going up forever. I met a guy, and he looked at me and he looked at my father. He said, "I will tell you exactly where the markets will be next year." And we're like, "Oh, where?" He's like, 8.5% higher, because that's what it does every year. And I believed him because I was a college freshman, and here was this really successful old guy. And I thought, okay, he's got to be right. So the expectation of 9 to 10%, the opposite of that is true. The market is a roller coaster ride when you're looking at it from year to year. Once you look at multiple decades, that's when it starts to look smooth. That's because markets move in cycles. They always have, and they always will. As I always say, there are 3 guarantees in life. You've all heard death. You've all heard taxes. I add cycles to that. Not because people are irrational all the time, but because human behavior has not changed and probably will not change for the rest of time. These are the things, the fear and the greed is what got us to stick around as a society. So let's walk through the major cycles that investors experience and why understanding them is what matters the most. So bull markets are first. They're periods when optimism is high, prices rise, there's good news everywhere. That tends to be towards the late end of the bull markets. You should have experience with these, considering we're in one, and we're in one of the strongest ones ever. A bull market is classified as a 20% or more rise in stock prices. Now, historically, they tend to last many years, sometimes much longer than people expect. That's why they're so insanely seductive. And there is a difference between cyclical bull markets and secular ones. Cyclical are shorter-term ones that are followed quickly by bear markets, and secular bull markets are what we're in right now, in addition to the regular one. Long-term, 15, 20-year bull markets where stocks go up. At the end of these is when things tend to feel and act more irrationally. Now, you can typically start to tell when we're nearing the end of a bull market because most investors start believing that 15 to 20% returns per year is just the norm, and that pullbacks, if they do happen, it's back to onward all-time highs, and actually start to feel like 5% pullbacks are the big ones, and the 10, 20% ones are a thing of the past. Now, bear markets are the opposite. They're prolonged declines of 20% or more. Now, throughout history, They happen far less often than bull markets. But what most people are too afraid to tell you is that they're completely unavoidable over long periods of time. What's important to understand is that bear markets don't require the economy to collapse. You don't need a recession to have a bear market. They can just be simply because expectations got too high. When reality disappoints even slightly, prices adjust, sometimes really quickly. In fact, some could argue that the start of a bear market could lead to a recession because all of a sudden we have this wealth effect and we feel like we're not as wealthy anymore, so we stop spending personally, and that leads to recessions. Now, speaking of recessions, these are actual economic slowdowns, and they're supposed to occur rather regularly, even in the healthiest economies. Since the end of World War II, there have been a total of 12 recessions in the US. That means on average, the US experiences a recession about every 7 years. Those 12 recessions lasted an average about 10 months. Now, I compare recessions to getting a cold. They suck, don't get me wrong, but it's something that you need in order to reset. The economy can't just go up forever year after year, and when that happens for too long, that could be a problem, and look out, things could get ugly. Now, guys, I'm going to quickly point out that prior to World War II, there were recessions way more frequently, like every 2 or 3 years, and they lasted a lot longer too. Before the Great Depression of 1929, 1873 marked the largest recession in U.S. history. Now, famous investor Peter Lynch has a great quote regarding the term correction. He says it's a euphemism for losing money rapidly. Corrections are price declines of roughly 10 to 20%, and even more normal than you'd think. In fact, they happen frequently, every 1 to 2 years to be exact. Yes, even during strong bull markets. We've actually seen it multiple times over this huge run the past few years. Corrections are the market's way of releasing pressure. Lynch experienced multiple corrections when he ran Fidelity Magellan Fund, and he says his portfolio fell more than the market every single time. But that didn't keep him from returning over 30% per year. Here comes one that really scares people, one we haven't really seen in a full form as of late, a stock market crash. Crashes are more rare, but they almost always involve two ingredients: leverage and overvaluation. When borrowed money meets unrealistic expectations, small problems turn into big ones. Crashes feel sudden, but in hindsight, the conditions were usually visible for years. The average market crash over the past 100 years saw stocks lose 38% of their value, and it usually happens very quickly. What's interesting is, if you look back, Berkshire Hathaway was almost always building cash leading up to these major falls. Now, every generation of investors believes they're living through a moment that breaks the rules. There's a famous quote by, I believe, John Templeton, where he said something along the lines of, "This time it's different," are the 4 most dangerous words in investing. Guys, that's not because innovation isn't real. It's very real. Look at our world today versus 100 years ago. Think about history for a second. In the late 1800s, railroads transformed the United States. They connected the country, accelerated the economy, made the world far more productive. The innovation was real. We still use them today, like 200 years later, but that didn't prevent people from leveraging up to build railroads that never became profitable, causing the panic of 1873. The stock market literally had to shut down for 10 days. Now, guys, not so long in our past, I know a lot of viewers here were probably born in the 90s, some even later, but fast forward to the 90s, the internet changed the world. I'd argue that the internet changed the world way more than people expected. The innovation was real, but investors bought ideas, not profits, not cash flow. Valuation didn't matter. And when expectations finally collided with reality, the NASDAQ fell nearly 80%. Now today, AI sits in that exact same place psychologically. It will increase productivity, it will change business models, and even entire industries will likely change or go away. But what history teaches us is that innovation itself does not protect investors from overpaying for it. Every cycle feels different while you're living through it. The language changes, the technology changes, the narratives evolve, but the behavior never does. Investors extrapolate recent success too far into the future. But let's discuss how AI really could drive the market for years to come if it works out perfectly. So what if AI actually delivers on its promise? Higher productivity, lower costs, increased margin, and unlocks entirely new revenue streams around the economy. Well, what if companies deploy capital much more efficiently, automation accelerates, and growth rates increase? Now, because of where we stand today valuation-wise, I personally wouldn't think that the market will continue upward at the rate we've seen the last few years still. But why this could work is earnings would grow faster than prices rise. lowering valuations and GDP growth would accelerate. I do want you to understand, though, that even in that scenario, returns will not be evenly distributed. Great decades don't reward everyone equally. They reward investors who bought strong businesses before perfection was priced in, not those who chased them after years of outperformance. Remember, Peter Lynch, in his massive outperformance, said very few of his investors did as well as the entire fund did. Why? Because they entered after his performance was already almost done. Same with Cathie Wood. When her ARK ETF was at 160, the losses that people had when it fell to 30 were far greater than they should have been if people had invested from day one, because people always jump in late. So in other words, if this bull market lasts another 10 years, the investors who make the most money won't be the ones who believed hardest in the story. They'll be the ones who paid reasonable prices for great businesses and just let compounding do the work. That means being a little bit early. And that leads us to the uncomfortable question most investors don't want to ask. What if the bull case doesn't come true? What if all this AI capital spending doesn't translate into profits people are expecting? What if companies spend hundreds of billions building data centers, buying chips, and hiring engineers only to find that returns take far longer to materialize or don't show up at all? Or, what I think is more likely, as margins go up, more companies enter, margins come back down. It's no coincidence that margins have been pretty consistent over the last 50 to 100 years, even though technology has made everything more efficient and more productive. There's a real risk that some of today's most talked about companies are promising future revenue while lending money to one another, subsidizing growth, and inflating valuations, a concern that investors like Michael Burry have raised in recent months. Now layer on the balance sheet risk. If companies like Microsoft, Meta, or others take on massive debt to fund AI infrastructure, they fundamentally change their business models. They go from capital light, high ROIC machines to capital-intensive businesses that may need a decade plus to either pay down that debt or to repay their investors in the cash they outlaid for that. When this happens, the market re-rates what multiple they'll apply. Instead of paying 25 or 30 times earnings or higher, the market drifts back toward long-term averages like 15 or 16 or even further down. Because when you swing the pendulum, you don't stop at regular. You go far beyond it. This is how investors lose money. And this is exactly why smart investors don't just ask what's the best possible outcome. They ask, what happens if I'm wrong? And will I still be okay? And that brings us to what I consider to be the most important part of this entire conversation. The uncomfortable truth about investing. You don't control the economy. You don't control interest rates. And you definitely don't control how AI will succeed or fail. You control one thing, the price you're willing to pay. That's why valuation matters so much. When investors talk about valuation, they're not trying to predict crashes. They're trying to understand future returns. High valuations don't tell you when the market will fall. But as Howard Marks has said many times, every single time in history that the market has traded at or above the current forward PE, stocks returned between -2% and 2% for the next decade. Two of the most widely followed long-term valuation measures provide more insight into what he means. The 10-year Shiller PE ratio, which smooths out earnings over a full economic cycle, is just below all-time highs. The Buffett indicator, which compares total market value to the GDP, is the highest we've ever seen by a long shot. Neither of these tools are a timing mechanism, but both have been reliable at showing future lower returns. Guys, here's my world-famous stock market to GDP PDF. And by world-famous, I mean, literally, I'm the only one that cares about it. But we are currently at 126% overvalued. Guys, here is the spectrum of overvaluation and undervaluation. This is going back 400 quarters, 100 years. When we were 30% or more undervalued, returns over the next 10 years averaged 10.7%, not including dividends. And look at this. This is undervalued, and this is going towards overvalued. Look what happens returns. 10.7, 9, 2.0, -1.1, -2, -2.4. It is not a coincidence. It makes perfect sense. The more you pay for a future stream of cash flow, the less return you're going to make. If I were to tell you right now, I'm going to give you $1 a year for the rest of your life. If you pay me $1 million for it, you're going to lose a lot of money. If you pay $1 for it, you're going to make a lot of money. It's the exact same stream of cash flow. You're just paying a different price. And this is where value investing comes in. Value investors estimate what a business is actually worth by looking at its potential cash flow, its potential growth, its potential margins, and the return that they need on their money for that. They don't ask, what's the stock going to do next year? They ask, okay, if this business performs reasonably well over time, does today's price give me an attractive return on that future performance? And here's the key point. Valuation is not about pessimism. It's about discipline. It's about understanding. Now, this is where disciplined investing really separates itself from speculation. One of my favorite concepts. It's called the margin of safety. And the idea is very simple, but incredibly powerful. Your margin of safety is the gap between what something is worth and the price you pay for it. It gives you room for mistakes and surprises because investing without margin of safety assumes perfection and it assumes you know the future, and that does not exist. One of the best examples is Warren Buffett. He says when an engineer is told to build a bridge that can hold 10,000 pounds on it, they do not build a bridge that holds 10,000 pounds. They build a bridge that holds 20,000 pounds. They need that margin of safety. And one of the clearest explanations of this concept comes from Seth Klarman, one of the most respected value investors of all time. He literally wrote a book called Margin of Safety. It's so rare that it sells for nearly thousands of dollars. And yes, before you ask, I used to own a copy. It got lost in a move, along with a Warren Buffett signed copy of Security Analysis. So if anybody out there finds my signed copy of the third edition of Security Analysis by Warren Buffett and finds and by the way, my copy of Margin of Safety is not signed, it's just they only made 5,000 of them. It's so powerful because the margin of safety works in two different ways. First, as I mentioned, it protects you from a downside of being wrong. A company doesn't have to perform as well as you forecast for you to still make solid returns. But on the other hand, if you're right, you're going to make outsized returns. And when you combine that mindset with long-term ownership of quality businesses, you create the conditions where wealth is built, regardless of whether this time is different or not. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Now, this is where a lot of people will get disappointed because the truth is far less exciting than the stories you hear. Millionaires in the stock market are made by following a repeatable process, like value investing over long periods of time or dollar cost averaging and being disciplined. Now, everyone wants to get rich fast. Every great investor and business person will tell you that's a big problem. It's about getting rich slowly. For most investors, that process starts with always being invested. That means consistently dollar cost averaging it into ETFs so your money is working for you no matter what the market does. Time in the market matters, but that's only part of the equation. The second part is selectively buying individual businesses when opportunities present themselves. That doesn't mean owning 100 stocks. It means building a diversified portfolio of maybe 20 to 30 high-quality companies bought only when the price offers a margin of safety. This is how wealth compounds. Now, guys, I want you to keep in mind, usually when that great price occurs, there's a story that tells you why it will not work out. That's what separates real investors from speculators. This is how all the best have done it. You buy strong businesses when they're temporarily misunderstood, ignored, or disliked. You don't try to exit in 2 months. You hold them through the ups and downs. And over time, the math of compound interest does the heavy lifting. Let me show you. When people use our retirement calculator in our software, they're often shocked by how powerful this approach is. Modest, consistent returns over decades can turn ordinary savings into extraordinary wealth. Here is age 30, retiring at 65, somebody with currently $100,000 in savings, saving $12,000 per year, increasing it by 4% per year. 9% returns during their lifetime, 6.5% during retirement, and living to age 95 with a 3.5% inflation. I'm not gonna worry about the spending now because I wanna focus on what the end values are. Guys, a person who does this consistently finishes with $7.5 million. But guys, look at them. They're not putting much in. At their biggest year, they put $47,000 in 35 years down the road, which is equivalent to today, like $15,000, maybe $12,000. That's incredible growth. Now, let me show you a situation in which if you do things the right way, if you do ETFs and stocks that are able to buy at the right time, you buying undervalued stocks and increasing your returns by 2% or 3% per year, let's do that. Let's just go to 2% per year. Remember, we saw 7.5 million. Let me add just 2% to that. And again, I'm not sitting there saying it's easy to beat the market. It does take effort emotionally to do that. And let's say in retirement, you're still such a great stock picker, you continue on at 8%. And by the way, on the previous example, you also die with 16.5 million. So you end up with 7.5 million in retirement, you die 30 years later with 16.5. Now, with our new numbers just increasing by 2%, guys, you retire with $11 million and you pass away with $68 million. Time is your friend when you're making good decisions. So when you step back and look at everything we've covered, the conclusion becomes unavoidable. So let's bring this home. Maybe it is different this time. Maybe AI delivers on every promise and this bull market keeps running for years to come. If that happens, disciplined investors will do just fine because they bought great businesses at reasonable prices and they bought low-cost ETFs month in, month out, quarter in, quarter out, and they were invested. But if history does what history usually does, if growth eventually disappoints and expectations come back to earth, disciplined investors will still be standing because they didn't rely on predictions, they relied on process. And now they're going to look at it saying, my process worked when stocks were double the price today, it's going to work even more when stocks are half. That's the real message here. Millionaires aren't made by guessing when the next recession comes in the next 6 months or 6 years. They're made by consistently buying quality businesses, demanding a margin of safety, staying invested, and having the patience to let time do the heavy lifting. It's often called the eighth wonder of the world, compound interest. You don't need to know what the market's going to do next. You just need to be prepared for what it does, because when you're not prepared, you're shocked and you make bad decisions. And whether this time is different or exactly the same as every other time in the history of the world, no matter what we're talking about, that preparation is what creates wealth. So guys, if you enjoyed this video and want to learn the detailed process I use to determine the right stocks to buy, and more importantly, the right price to pay for them, click on the video right here for our full course. I promise you, you won't be disappointed. Thank you for your time.